We are diving straight into two of the most critical legal and ethical violations you will encounter on the National Real Estate Exam, which are commingling and conversion. These concepts center around the handling of trust funds, such as earnest money deposits or tenant security deposits, and they are tested heavily because they involve a broker's primary fiduciary duty of accounting. Commingling happens the moment a broker mixes client funds with their own personal or business operating funds. Imagine you receive a $5,000 earnest money check from a buyer, and instead of depositing it into a dedicated escrow or trust account, you drop it into your brokerage's general operating account because it was more convenient at the end of the day. Even if you never spend a single cent of that money and you keep it perfectly safe, you have already committed commingling, which is a serious violation that can lead to immediate license suspension or revocation. The exam will often try to trick you by suggesting that as long as the broker keeps a detailed ledger showing exactly how much of that account belongs to the client, it might be acceptable under certain emergencies. But you must remember that it is never legal to mix these funds. Trust funds must remain in a separate environment to protect them from being seized by a broker's creditors or frozen during a personal legal dispute. Now, conversion is the more severe version of this violation, and it occurs when a broker actually uses that client money for any purpose other than what it was intended for. If that same broker sees a late rent payment for their own office and decides to use a portion of the buyer's earnest money to cover it, with the full intention of replacing the funds as soon as a commission check arrives, they have committed conversion. Conversion is the legal term for what is effectively embezzlement or theft because you are converting someone else's property into your own personal use. A common exam trap involves a scenario where a broker uses trust funds to pay for an emergency repair on a property that the client actually wanted fixed, but the broker used a different client's money to pay the contractor. Even if the broker was trying to be helpful, using one client's funds for another client's benefit is still conversion. You must remember the mnemonic that commingling is the mix, while conversion is the spend. On the test, you should look for specific keywords like deposited into the wrong account to identify commingling, and phrases like used for office expenses or diverted for personal use to identify conversion. Another subtle point to watch for is the small exception where a broker is often allowed to keep a tiny amount of their own money in the trust account, specifically to cover bank service charges and keep the account active. If the exam asks about this specific scenario, it is generally not considered commingling as long as the amount is nominal and strictly for maintenance fees. However, any amount beyond that is a violation. If you see a question asking about the legal consequences for these actions, remember that both are grounds for the permanent loss of a real estate license, and conversion often carries additional criminal penalties because it is viewed as a form of larceny. When you are sitting for the national portion of the exam, always assume that the rules regarding trust funds are absolute and that no amount of client permission can excuse the unauthorized use of these assets. By keeping these two definitions distinct, you will easily navigate the situational questions that describe a broker's messy accounting practices.